over the past 10 years, CVS is down by 45%, recently hitting their 10-year low. Now, this 10-year low seemed to be an overreaction by the market. The company dropped from $60 all the way down to $44, but then it rebounded back to about $60. So let's jump to my stock valuation spreadsheets, where I will, as always, plug in CVS's ticker and wait for all the metrics to show up. Now, the first thing that captures my attention is the company's high dividend yield, sitting at 4.75%. And this dividend yield is actually the highest it has been over the past 10 years. And just to show this to you in perspective, for most of the past 10 years, CVS's dividend yield was sitting between 2 to 2.5%. So currently it is sitting 100% higher. And this gives you a chance to buy the company at a premium yield on cost into the future. Now, something I also want to point out is that over the past 5 years, CVS's trailing free cash flow payout ratio was sitting at about 26%, which means that after paying out their dividends, they still had about 75% of their free cash flow left to push into innovation, buy back shares, pay down debt, etc. But in 2024, all of this changed. So jumping to the 9-pillar analysis, the company gets a decent rating of 7 out of 9 with only 2 pillars in the red. So let's pick all of this apart. The 5-year PE ratio is sitting at 15.14, which would indicate an undervalued company. If I jump closer to pillar 1, you can see that currently the PE ratio is actually sitting even lower at 14.20. Now, regarding the price to free cash flow, that is sitting at 6.94, which again is lower than the 5-year average. So overall, you could say that CVS is undervalued compared to the free cash flow and compared to the earnings they have been generating. Now, what you have to understand is that as a long-term investor, the most important thing you want to see within your company is financial growth. CVS's 5-year revenue CAGR is sitting at 6.60%, which is decent, but their free cash flow is sitting at negative 25.95%, and their net income is sitting at only 3.80%. So let's have a look at the free cash flow, that is pillar 9, and we can see that from 2021, it dropped from about 16 billion to only 1.6 billion in 2024. That is a huge decrease in a 4-year period. Now we can also have a look at the net income, which has also decreased from 8 billion to 5 billion over the past 4 years, and the revenue, which actually increased from 267 billion in 2020 to 367 billion in 2024. So an increase of about 100 billion in the 5 years, which is quite decent actually. So why is the revenue increasing but the net income and the free cash flow are decreasing? Well, the reason for that is the profit margin. Post-pandemic, most healthcare stocks have been struggling with higher costs. And that's why CVS's profit margin is so low. Their 5-year profit margin is sitting at 2.10%. But if we move in closer, over the past 5 years, it has dropped from 2.68% to only 1.37%, which it is sitting at currently. Now you might say to yourself that a drop by about 1 percentage point isn't that much. But if you think about it, over the past 5 years, the profit margin dropped by more than 100%. So that is a lot. And that's the main reason for CVS's free cash flow and net income decreasing. Now, the healthcare sector, which CVS is in, has always been and always will be a very, very important sector. And that's why I believe that even though CVS's free cash flow and net income fell over the past 4 years, that it will start recovering in the next years. And the analysts actually seem to agree with me on this one. In 2024, the EPS was expected to drop by 40%, but in 2025 and forward, it is expected to grow between 14 and 20%. Now, before getting to calculating the intrinsic value of CVS, I just want to let you know that if you want to download these spreadsheets for your own personal use, you can always do so at the link in the description. We are currently running a 20% discount, which will end in 6 days. Now, let's have a look at a few more metrics. CVS has been buying back shares at a decent rate of 0.67% yearly over the past 5 years, and their 5-year dividend CAGR is sitting at 5.49%. Now, if I zoom into pillar 8, you can see that that is higher than the average stock year-over-year dividend growth. Also, as I mentioned at the start of the video, their 5-year free cash flow payout ratio is sitting nice and low. But if I scroll down, you can see that in 2024, the free cash flow payout ratio was sitting at 196.44%, which means that CVS was going into debt paying out their dividends. Now, as we know, this high free cash flow payout ratio is because of the big drop in free cash flow in 2024, so I'm not really worried about it, as I do believe that it is a one-time thing. Now, let's also have a look at the debt of the company. If I jump to pillar 9, you can see that they currently have $92 billion in long-term liabilities. So their long-term liabilities over the 5-year free cash flow negative dividends is sitting at 1.87, which means that with the average free cash flow they have been generating over the past 5 years, that is about $10 billion annually, they would be able to pay off all their long-term liabilities while paying out their current dividends in about 10 years, which with me is completely fine. So now that we have gone through the 9-pillar analysis, let's calculate the company's intrinsic value. So moving to the Grams formula, I will predict the high earnings per share growth at 12%, medium at 10%, and low at 8%. And combining this with all the other values, plugging them into the Grams formula, we will get an intrinsic value of $123.56, which is 121% higher than the current trading price, showing us that CVS is really undervalued compared to the net income they bring in. Now let's also jump to the discounted cash flow model, where, as we know, the free cash flow dropped to $1.6 billion from $10.3 billion in 2023. So we will use the $1.6 billion as the initial growth number, and plugging in growth rate into the future of 8.3%, we will calculate the future free cash flow. After that, I will plug in a discount rate at 4.3%, and we will get an intrinsic value sitting at $58, which is still higher than the current trading price, with the very low free cash flow of $1.6 billion. Now, I just want to point something out. If I plugged in the free cash flow at $5 billion, which is quite lower than what it has been sitting on average over the past 5 years, we will get an intrinsic value of $290, much higher than the current trading price. And this just shows you that if CVS returns to its former glory, its value will skyrocket. Now, for the sake of the valuation, I will return the initial growth number to $1.6 billion, and we will move to the third valuation model, where I will compare CVS to 3 of its competitors. I will take these competitors' current P ratios and average them out, multiply them by the EPS of CVS, and get an intrinsic value of $89.88, again higher than the current trading price. And finally, moving to the dividend discount model, I will predict the growth rate at 2.17%, the dividend growth rate that is, as I do believe that CVS will have to lower their dividend growth in the near future. And this will give us an intrinsic value of $127.96, again more than 100% higher than the current trading price. And finally, when we average out the 4 valuation models, we will get an intrinsic value of $99.86, which is 77.5% higher than the current trading price. And with a margin of safety, let's go with 50%, we will get an acceptable buy price at $49.93. So let's go with 40% actually. And that will give us an acceptable buy price at $59.91, which is slightly higher than the current trading price. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.